All right, good morning everyone. Welcome back to Macroeconomics. So last week we started a new topic, and that new topic I gave the broad heading money and banking. And of course last week we talked extensively about the money part. And so that means that today we need an introduction to banking. And this is really not just about banking, because banking is only one part of the much larger markets where funds are exchanged between borrowers and lenders. If you and I wanted to borrow, we'd probably go to a bank. But there are other ways in which entities can raise funds. And we'll actually talk about some of those other ways later today if we have time. But broadly, this whole market where through different ways, through banks or otherwise, people raise funds or lend funds to others, that whole thing is called the financial system or financial markets. So we're going to focus on banks, but really what we're doing is developing a broader insight into the functioning of financial markets. Okay? So that's the plan. Now, in order to think about what banks are and what they do, I find it useful to imagine some sort of simplified world where we can focus on fewer things. And in particular, I like to go back to, let's say, imagine sometime in the distant past where there is no banking. And then we'll see how in a place in the distant past where there is no banking, there is nonetheless a sort of natural way for banks to emerge. So let's imagine some place in the distant past where, to make things concrete, let's imagine that in that distant past there's a form of money, and that form of money is gold. Now, of course, in this world, lots of people have gold. They use it for various transactions. But it's just life. Nobody is equal. Sorry, we're not all equal. There may be some very wealthy people. And if you're a very wealthy person in this environment, it means you have a lot of gold. And if you had a lot of gold, you'll need some way of looking after it. It's certainly going to be more than you can just carry on yourself, which means you'll need some way of storing it. And that means either you'll have to pay guards to look after your house, or you'll have to find someone who's going to look after it for you. So they'll need somewhere to keep their large amounts of gold. And so here there is a natural demand for some sort of safekeeping of money. Now, a natural person who might be able to provide that service might be someone who already uses gold for other purposes. Let's say the local goldsmith. Right? Goldsmith is someone who already has facilities for handling precious metals, so they might be a natural person who just can provide this additional service, which is to keep gold that belongs to the wealthy people from the ancient times. So, suppose this goldsmith does begin to look after other people's gold. this goldsmith is going to need to keep a list of who they owe gold to, right? Who does the gold that they're looking after belong to? Let's say 1 ton of gold belongs to Professor Yeazer, and let's say 2 tons belong to Professor Mackey, and let's say 3 tons belong to Professor Saranovic. So these are the wealthy merchants of the time. They give their gold to the goldsmith to look after. And of course, if we add up all these numbers, we'll have some total, which will be the total amount of gold that the goldsmith has for safekeeping. Okay, so now we have a natural business model arising here, which sort of looks like some of what banks do, right? Banks do this for you. We deposit our money in the banks in form of checking accounts, savings accounts, and whatnot. So it's not gold, but it's the same thing. The bank is looking after our funds for us. However, there's another thing that's going to grow out of this system naturally once we have this safekeeping business in place. And that's the following. Notice that all of this gold that the goldsmith is looking after, or to give it another name, all this gold that the wealthy medieval professors deposited with this goldsmith, all of those items of gold presumably have a receipt. Right? When Professor Yeazer came and left his ton of gold there, he must have left with a contract that says the goldsmith owes Professor Yeazer 1 ton of gold. Right? Because he needs some document that proves that this gold belongs to him in case there's a dispute. But suppose that instead of the contract being written this way, instead of specifying Professor Yeazer, or whoever it is, suppose instead it said the goldsmith owes whoever owns this contract. Let's call whoever owns this contract the bearer. Now what is this piece of paper? This piece of paper is still a receipt. But now this piece of paper itself can be used as a means of exchange. Instead of paying someone gold and carrying around gold, I could instead carry around these certificates or whatever they are that correspond to gold that's somewhere. And then, this is paper money. So, in a world where there's something that's used as money, the wealthy may have a demand for security services, which begins to look like a bank, and then the receipts that those wealthy people take away could in principle themselves circulate as money if they are written up in this way, such that they're easy to exchange because the person who gets it can then use it later either as a means of exchange or to get the actual gold if they feel the need. In addition, these pieces of paper could begin to circulate far away from wherever the gold is, which is useful because it means the gold doesn't have to move around. Gold is heavier than pieces of paper. Okay. Any questions or thoughts about this? So then, deep down, originally, Paper money is kind of a sort of receipt. Now, there's another thing that's going to happen here that's going to make this look even more like a bank. And that is the following. Now that there's paper money, although this might be true even without the paper money, these wealthy medieval professors don't need to come and pick up their money. Their gold, rather. Because they're off here maybe buying and selling with these paper certificates. And anyway, they don't need their gold every day. Right? The whole point is that it's sitting there for safekeeping for some period of time. They may show up every now and then and take some of it out. But most of the time, it's just sitting there gathering dust. And so this goldsmith might realize, there's an additional way in which I can generate profits here. One way I generate profits is by charging these people fees for safekeeping. But now, given that the gold is just sitting there most of the time doing nothing, there's something else I could do with the gold, which is I could lend it to people. Now I need a second list. Some of the gold I still have to keep there just in case someone shows up, right? So some of it, let's say 2, I have to hold in a reserve. I have to have a reserve there in case someone comes and wants to take some out. Then, of course, if Professor Yeazer comes and takes out his ton of gold, then the reserves drop because 1 ton left. But the rest, I can loan. And I decide, what's the right balance between how much do I want to hold in reserve, how much do I want to lend out. And of course, this has to add up to the same total, right? Because these aren't 2 different things. There's just one pile of gold. This list is telling me who it belongs to. And this list on the other side is telling me what did I do with it. And the answer is, well, either I lent it or it's still down there in the vault. And so both of these sides have to add up to the same number because they're not 2 different lists. They're just 2 aspects of the same pile of gold, who it belongs to and where it is. So this thing, this pair of lists where everything has to add up, is called a balance sheet. And these 2 halves of the balance sheet have names. This half, where you track where did the gold come from, is the same thing as saying, who do I, the goldsmith, owe this to? So this is known as liabilities. All right? And this list, which tells me in what form is the gold, is called assets. Okay? So this is a very simplified picture of how banks work, but it's a good start. So what we're going to do next is we're going to write up what a balance sheet looks like nowadays. We'll see that many of the key elements are going to be the same. There are going to be a few additional sources of funds and uses of funds that we'll want to discuss. But deep down, this is, it's going to be the same idea. And the key lesson to take away at the moment is that these two sides always have to be the same, and it's not because of any magic, it's just because these are, as it were, two sides of the same coin. There's one coin, it belongs to someone, and it's in some form, in this case, a coin. Okay? Any questions, thoughts about this? And of course, all banks and other financial institutions have balance sheets, but really, any economic entity has a balance sheet. You have a balance sheet, right? Where you have certain, maybe you owe something to someone, and then it's in some form. So all companies have balance sheets. But for us, the balance sheet is going to be a useful window into how the financial system works. So let's clean this side of the board and use it to write a new balance sheet for the modern day. So on this side, first we have sources of, I'm not going to write gold, I'm going to write funds, which is a pretty general word. And this is the liabilities. And here we're going to write uses of funds. In what form are they? Also known as assets. Okay. So, what does a bank do nowadays? On the liability side, where do they raise money from? Well, they raise funds the same way that this medieval bank does. They take in deposits. I'm just going to write a number for how many deposits they have. $100 billion or something. But this isn't the only source of funds that banks nowadays have. If you needed funds now, what would you do? You probably wouldn't go and tell your friend, give me your money for safekeeping. What would you do? You'd borrow, exactly. So banks can borrow too. So let's write that here. We're going to call it borrowings. Let's just give it a number. I'm just making up numbers. The key about the number is that it's smaller, which is generally going to be true, with a few exceptions. So the logical question is, who do banks borrow from? And there are actually two answers. Sorry? That's right. One place that banks might borrow from is from other banks. If a bank borrows from another bank, that's called an interbank loan. But in the United States, interbank loans have a special nickname, which I think it's worth knowing. And in the United States, an interbank loan is known as a federal funds loan. And the interest rate banks charge each other is called the federal funds rate. So of course, for any loan, the payback's generally going to be larger. That's the interest rate. It's a little confusing because, again, it's a loan between banks, so why is it called the federal anything? There's a good reason, but we'll get to it eventually. Just remember that's what it is. However, that's not the only source of loans for banks, of borrowings, I guess, to be careful. Because, well, most of the time, when banks borrow and lend to each other, what they're doing is they're trying to fine-tune the size of their balance sheet or fine-tune something about it. A lot of these loans between banks are like literally overnight loans. I lend you something today, you pay me back tomorrow morning. They're just sort of fine-tuning certain things on their balance sheets. But what if there's an emergency? Imagine that something really big happens in the United States, something that makes banks feel threatened. And they feel, you know what, I need to borrow because I need to have some extra cash on hand for this oncoming emergency. Well, in that situation, all the banks are trying to borrow at the same time. So there is no interbank loan market. That would be a problem. What would happen intuitively? What would happen if something is threatening the banking system and they all feel at the same time we need to boost our balance sheets so we have extra funds just in case? Think demand and supply. If everyone's borrowing at once, what's going to happen to interest rates? They'll go through the roof. The interest rate is the price of borrowing $1, something we'll look at in a second. And so if suddenly everyone wants to borrow that thing, well, its price skyrockets. And that would be a problem for anyone who's exposed to the lending market. So, primarily for such emergencies, there exists another entity that lends to the banks, and that's called the central bank. And in some countries it's a government entity. In the United States it's this interesting mix of government and private. In any case, there's this thing called the central bank that's out there, and its original function was to be what's called the lender of last resort. In other words, if no one will lend, because everyone's trying to borrow because it's a crisis situation, the central bank will lend. The central bank in the United States is called the Federal Reserve System, but it's also known more affectionately as the Fed. So a loan from the central bank is known as an official loan. It just means it's from the central bank. And just like interbank loans, loans from the central bank have a special nickname in the United States. They're also known as discount loans. And of course, yes, the rate that the Fed charges banks on discount loans is the discount rate. So, given that there are these two alternative sources of borrowings for banks, you might think, well, the Fed basically invents this rate. Right? They control it fully. They're the only source of discount loans. So that would suggest that maybe directly or indirectly the Fed has some control over this as well, since it's a substitute, a very close substitute. And in fact they do. And this is something that we'll look at later in the semester. But the Fed is able to influence both of these, this one directly, this one indirectly, to try and manage the financial system and, by extension, the macroeconomy. And when the Fed does that, that's called monetary policy. And when you hear about monetary policy, you probably often hear about it in terms of the Fed changing interest rates, the Fed raising interest rates, the Fed lowering interest rates. The rate they mean is the interbank loan. It's the Fed funds rate. But again, you can just intuitively think, well, all interest rates are pretty close substitutes. Right? They're all different kinds of loans, but some entities have a choice of where to borrow, so when you change one interest rate, the others are probably going to move together. And that's true. Yet, when the Fed is changing interest rates, specifically the rate, we mean generally, unless it's specified, is the Fed funds rate. Okay? Keep that in mind. Great. So, we have deposits, we have borrowings, And there's one more source of funds that I think is important to understand well, and that is the following. Suppose I am this goldsmith. I am doing this because it's profitable. I'm running this medieval bank because I earn income from it. I earn income because I charge people interest. I earn income because I charge fees. And so let's imagine that I generated a certain amount of income over the year. There's two things I could do with this income. One thing I could do is take it away and consume it. But I have this very profitable business here. So there's an alternative thing I could do with my income, or at least with part of it. I could take some of it and put it back into the bank as an additional source of funds. If I did that, these wouldn't be funds that belong to medieval professors, they would be funds that belong to me. And the same is true here. Whoever it is who owns this bank is generating profits regularly, and they could take some of it and put it back in the bank as an additional source of funds. If they do that, that's called bank capital. That has some value, and it's an additional source of funds. I raise funds from depositors, I borrow, or I put in my own money. Who owns banks in practice, since we're on the topic? In the United States, banks in general are owned by very large numbers of people. You're going to suggest a name for them, I think. The shareholders, yes. So the way it works here is the bank sells an ownership stake in itself, and then that makes you the part owner if you buy those shares. So banks in the United States tend to be owned by a very large number of people because there are lots of people who own the shares. That's not true everywhere. In some countries, the government owns the banks. And in some countries, very wealthy people own the banks, like the King of Sweden is a very wealthy person who has big stakes in the local banks. Either way, regardless of who owns the bank, these are funds that belong to the owner or owners. So we have all these possible sources of funds. We add them up. We're going to get a total. Next, assets. We know that the value of the assets has to equal the value of the liabilities, by definition, because these aren't two different things. They're different aspects of the same thing, the pile of funds that the bank is managing. This just tells us who they belong to, and on this side we're going to write down in what form they are. So one thing the banks could do with some of their funds is nothing. Because just like our medieval bank, there might be some customers who come in and want to withdraw some of their deposits. Let's say if a customer comes in and wants to withdraw 1, this drops to 99. And of course, it would have to come out of here, because those are the funds that the bank has that are right there. Then this would go down to 9. Okay. Now, just like this medieval bank, what's going on with the rest of the funds that the bank is managing? Well, some of it is out there in the form of loans. Notice this does net up to 120, and the reason is because there's another way in which banks can lend money, or to put it another way, there's another kind of asset that banks have on their balance sheets that I'm going to call securities. So For the moment, just imagine that securities are a kind of fancy loan. And then in a minute, we'll discuss what securities are, what's fancy about them, what's attractive about them, and I guess maybe what's risky about them as well. Okay, any questions, comments, thoughts about these items? Yes? So the bank capital is something we'll come back to later again, but for the time being, you can just think of it as being funds that correspond to the owner of the bank.
So, like, why are we using coupons, like, for assets?
So,
like, is that mean, like, we using money from the office, or like?
So, I mean, it's hard to really say that, let's say the reserves correspond to the borrowings or the deposits correspond to the loans. I mean, they just have one pile of funds, right? And this tells us in what form they are. And this tells us who they belong to. So, as I said, we will need to figure out what securities are. And I said for now we can think of them as a fancy loan. So why don't we look at what a loan looks like? And then we'll see how we can make it fancier. So what's a loan? Generally, a loan is just a situation where for some reason, let's say I have something that I need to pay for, but I don't have the funds right now. Maybe I'm trying to start a business, and of course that business will, if it's successful, pay for itself. But the business doesn't exist yet, so I need to borrow to get it started. So I will be going out trying to get from someone some quantity P for I need it now, I need it in the present. So maybe you have P dollars that you don't need right now, and you might be willing to lend them to me, but that wouldn't be for free. It would be in exchange for some other quantity, let's call it F dollars, in the future. So that's a loan. It's P dollars in the present, F dollars in the future, going the other way. And what makes this interesting for you, literally, is going to be that F is bigger than P. And this is what you're going to earn out of this contract. I'm paying you some, you're lending me some amount, and I'm paying you back more at a later date to compensate you for having had to wait before you got to enjoy your P dollars. There's another reason why I picked P, because as some of you may know, there is a name for the amount that you borrow, which is principal. Also conveniently starts with P. All right, so we are economists, and so we're not that interested in this number here. This is just a total interest payment that you get, but we'll be very interested in something else. We'll be very interested in knowing how much interest you're paying per dollar that you borrowed, because that sounds like the price of borrowing a dollar. Well, it is, right? So we're economists, so we'll not be so interested in this, but we'll be very interested in this per dollar that you borrowed. If we do that, that's called the interest rate. And if you compute this, you're going to get a fraction, right? But we generally, you probably get a small number because interest rates are 6%, 3%, small numbers. And I guess I just let it slip. We're going to usually talk about these in percentage terms, which means I want to take this little fraction and multiply it by 100. So instead of having an interest rate of 0.06, we'll say 6%. It'll be more convenient. All right. So that's a loan in a nutshell. What are securities in contrast to a loan? Well, here's an example of a security. Imagine the following. Instead of going to a bank or to some people and haggling about the value of P and the value of F, which of course, as soon as we've determined, immediately determines an interest rate, suppose instead I did the following. Suppose I wrote up a contract. The contract says, I, Professor Samaniego, will pay F dollars to, well, F dollars, you got to specify a time frame, right? Because next year, to whoever owns this contract. That kind of sounds like a loan, right? There's the F. But where's the P? The P is in this contract. How do we get the principal? Yeah? Yeah, I sell it. I sell this contract for a price, P dollars, which is, well, whatever I could get for this contract. And as soon as we've determined a price for this contract and executed that transaction, we've also determined an interest rate. Immediately, implicitly, through the same formula. Any questions, comments, thoughts? And of course, this contract is called a bond. James Bond. One question. What determines, if you thinking as an economist, since we're looking at this contract, what might determine the value of this contract? Yeah. So yeah, this is an alternative. These things are substitutes, right? Okay, you and I can't borrow this way. But if you're a company, you could borrow in either way. So these things are substitutes. So intuitively, what's happening to interest rates over in banks might be one of the factors that affects, well, what price can you earn from this contract? And in that regard, I want to show you something. Let's write down our formula for the interest rate over here. Observe the following. I'm going to put parentheses around this. Right? Haven't done anything. Now I'm going to distribute this 1 over P across the F and the P. In other words, this is F over P minus P over P. What's P over P? 1. So what happens to bond prices when interest rates rise? the interest rate is inversely related to the price. So for this equation to hold, the price has to drop. This is an important thing to know. Whenever you hear news saying interest rates just rose, it's also telling you bond prices came down, which would matter if you're someone who owns bonds. And in reverse, if someone tells you, bond prices dropped today, it's the same thing as saying interest rates rose. There's one other factor that might affect how much you're willing to pay for this bond. That's not just to do with what interest rates are doing in general. And that is, who is Professor Samaniego? Because they're bonds for different entities. And some entities might be more trustworthy than others. If you think I'm less likely to pay, that'll also affect this price, right? So the bond price is going to have two pieces. One is, well, what's going on in bond markets or loan markets in general, and the other is, well, how risky is this individual or this company? Great. What else can we do here? Well, I said these things are substitutes for the borrower. Right? They're going to go wherever the interest rate is lower. But what about for the lender? For the lender, this actually is nice in a way that this one isn't. Because this contract says that you have to wait until next year, our pre-agreed date, in order to get the money back. What if you decide that you need the money sometime before then? What can you do? Well, you can phone Professor Samaniego and harass him and trying to get you to pay back early, get him to pay you back early. That's called calling in a loan. But, if I can't pay you, I can't pay you. What about this one? What can I do if I suddenly decide, I'm not going to pay F until February in 2024, but it's June 2023 and you suddenly realize you need money. What do? I sell it. Exactly. So these things have what's called a secondary market. The primary market is the day that I actually sold it and raised funds to you, but there's a secondary market for these things where you can sell them on to someone else if you agree a price, which may not be the same as P and may not be the same as F. But so that's an extra convenience to whoever the lender is. And that's what distinguishes securities from loans. It's the fact that these things can be sold on to other people between, now and whenever it is that the final payment is made and the contract ends. That's pretty useful. So that's what securities are. Any questions, thoughts, comments? Yes? How do you sell them? Well, there's just there are exchanges. Just like there's a stock market where you sell shares, there is bond exchanges where you sell bonds. Or you can also hire a broker who will help find a buyer or a seller if you want to perform certain transactions.
So is it in person or does it go through like a bank?
Both are possible. Another thing you could do is you could open what's called a mutual fund, and then you just opened an account at a bank, and then the bank has people who decide which bonds to buy and sell, and you just get whatever earnings they manage to generate. So I raised this because there is another kind of security that I think is worth mentioning while we are here. And we end in half an hour. 12:25, right? Yeah. So we have half an hour. I think we're okay. Suppose that I had this exact same contract but instead of saying I, Professor Samaniego, will pay F dollars, suppose instead it said let's say 1% of my profits to whoever owns this contract. That's a bit different, right? In two ways. One, I didn't tell you a fixed amount. It depends on how things go. Two, it doesn't have an end date because my company is going to continue. And of course, this is probably not a kind of contract that I, Professor Samaniego, would write, but it's certainly a kind of contract that Apple or General Motors can write. And so, this, instead of being a bond, is a share. And this is also a kind of security, and this is a kind of security that is traded on the stock market. Now, when we were talking about bonds, we took a little time to think about, well, we're economists, we don't just memorize things, we try and understand them. So here's a bond, what is going to ultimately determine the price that that people are going to be wanting to buy and sell, at which people are going to want to buy and sell this bond? We came up with two answers, interest rates and risk. What about shares? Well, what do I get if I own this share? What do you get if you own this share? You get some share of my profits forever, for as long as you hold the contract. So what's going to determine how much you're going to be willing to pay for this thing? What you think the profits are going to be. So, suppose share prices go up. What does that mean? It means that you must have gotten some news that suggests that this company that issued the shares is going to have more profits. And again, not just in this instant, but in the future, right, over its lifetime, than you initially expected. So, for example, I just pulled up the prices of a particular share. I just picked Microsoft because they've been in the news a lot lately. Why has Microsoft been in the news a lot lately? ChatGPT. So this is going back a year, and you can see the share price of Microsoft shares. Let's see, they started it a year ago at around $300, and then you see they keep going up and down. Why is that? Well, anytime any news about anything comes along, it affects their expected future profits. So it goes up a bit, down a bit. If you look over the whole year, though, let's say all the way to here, January 6th, what's the share price then? It's about $225, right? Oh, it says there. Yeah, $225. So what must have happened over the course of the year from here until January 6th? There must have been, well, there was a bunch of news that affected Microsoft's outlook. Some of it was good, some of it was bad, but on average it must have been negative because it's gone down overall. And then interestingly, since January 6th, for whatever reason, the news has been better. So from this picture, we can't tell exactly what the news was, of course. If we were following day to day, of course, you would know what the news was. If you looked at what might have happened on a particular day, you might be able to glean what happened that affected their prices. But in general, again, if the share price goes up, it means some information hit that meant that you expected profits to be better in the over the long term, as opposed to news about exactly profits generated today. Great. So that's shares. Any questions, comments, or thoughts about how those things are traded? So shares also show up on the balance sheet, and if they would show up as a form of security. Now there are other forms of securities out there. I'm just going to mention it, I'm not going to write it up. There's a new form of, fairly new form of security that actually now is showing up on balance sheets all over the place called mortgage-backed securities. And the way those work is that some of these loans are mortgages, which is loans that are to help someone buy a house, or loans where the collateral is the house. And what some entities do, some banks do, is they'll package the payments from the mortgages into a security and sell those payments to someone. So then they may still have made a mortgage loan, but they're no longer getting the payments. They've sold the rights to those payments to someone else. And so those are another form of security that I'm just going to throw out there because later on when we start talking about business cycles, some of the details of what these securities are may matter. But for now, they're just contracts like this that you can resell if you don't feel like waiting until the final payment date. Any questions, comments, thoughts? So one more thing before we end, I think one more thing, is that we just discussed that these securities have prices that rise and fall. They rise and fall with news, right? Bond prices rise and fall with interest rates or with risk perception. Share prices rise and fall, well, with any news whatsoever, macroeconomic or specific to the company, that might change your outlook about their profitability. And that suggests that the value of these things rises and falls. Wait, but we had that this is a total value here. So that means this total can rise and fall in value. And then we also said that these two always have to be equal. So something here must be adjusting whenever anything rises and falls. So let's pick an example. Let's suppose that let's just say a lot of these are bonds. To the extent that they're bonds, a decrease in interest rates makes bond prices do what? They go up, right? And this bank has a bunch of bonds here. So what happens to the value of those bonds? They rise. So the bank is now managing a larger quantity of funds than it was before. Let me erase this for clarity. That means one of these items must have changed. Did the deposits change? No, it's not the case that a bunch of new clients came in. Just that the securities gain value. So this isn't changing. What about the borrowings? Bank didn't borrow any money. Aha! When the value of the securities that the bank is holding rises, what does it mean? It means there's more left over for the owner. Because this stuff hasn't changed. So it just means that the owner now has a greater stake in this thing. That all sounds great, but what if the opposite happens? What if interest rates rise? Well, we know bond prices drop. So what's going to happen to this bank? To the extent that these securities are in the form of bonds, which many of them are. A lot of them are actually government bonds, as in bonds where it says, I, the US government, will pay $100,000 to whoever owns this contract. Well, now the securities lose value. And again, the deposits haven't changed, and the bank's borrowing behavior hasn't changed. So again, this has to come out of the bank capital. It means when the securities lose value, there's just less left over for the owner. And there's another event that would have a similar effect. What if a bunch of these loans default? Like a bunch of lenders can't pay back their mortgages or whatever it was. Same thing would happen, right? Total value of the funds decreases because those loans are now worth less, or maybe even literally worthless. And what's left over for the owner goes down. So the process I described whereby something goes wrong and the bank actually ends up with less money than, well, with a decreasing pile of funds, in the extreme case could be quite a serious problem. Imagine that the securities lose, and we'll go over this on Wednesday in more detail, but imagine the securities lose value by more than 10. What's the bank capital? It's negative. What does negative bank capital mean? Well, it means that the total value of all the funds the bank is managing is not enough to cover the borrowings, which it owes to someone, and the deposits, which it owes to you. So if that were to happen, if the bank were to suffer a shock to the value of its assets so severe that it erases all the bank capital, this bank is bust. Well, the correct term is insolvent. And that would be a problem for you because they don't have enough funds to cover the deposits that they promised you. So what we'll see, and I guess there was a hint at this already, is that there is a lot of regulation, a lot of rules that banks have to follow, precisely because if anything they do goes wrong, it's your money, the money of the public, that ends up getting wiped out. So next class on Wednesday, that's exactly what we'll talk about. We'll go through the balance sheet again, and we'll have a look at different regulations that affect what banks can and cannot do. This discussion about, well, if you experience a shock so bad that it erases your bank capital, and that can kill a bank, that discussion suggests that where would be a good place to put regulations? Make sure that there is some minimum bank capital, or regulate the bank capital, make sure that there's enough. So that's one. What else is there going to be? Another is going to be, remember that, actually let's imagine the following. Imagine you think this bank is going to have no reserves tomorrow, or has very few reserves. What does that mean is going to happen if you, well, what should you do if you think your bank is running out of reserves? Go and get your money out before it runs out and is only left with things that it can't give you. If lots of people think this, what's going to happen? We all run to the bank and they immediately run out of reserves. So that's called a bank run. And what does that suggest would be another thing that you might want to regulate? The amount of reserves. And interestingly, in the United States there is a regulation about that, but many countries don't have such a regulation. Does that mean that banks in those countries, let's say New Zealand, I think, doesn't have a reserve requirement? Does it mean there are no reserves in those countries? No, it just means the banks decide, both for themselves. What else? There's another regulation in the United States. Again, this isn't true everywhere. If you open any sort of account, right, deposits, you have to be given by law, by the bank, a piece of paper that says either this account is FDIC insured or this account is not FDIC insured. What's the FDIC? Or rather, what does the FDIC provide? The DI in FDIC stands for deposit insurance. In other words, if the bank is unable to give you your deposits through the process we described, there's this other entity called the FDIC, which basically acts as an insurance company and will give you your money back if the bank can't. And then there was an additional regulation, sort of, which was the borrowings come from one source of borrowings is the Fed, and of course the Fed can also affect the interbank market, so there's more regulation. There's regulation everywhere almost. And then there's a further regulation because this is no longer true, but it used to be true that banks couldn't own shares. And you can sort of intuitively see why that might be the case, right? Remember Microsoft here? The value of Microsoft shares go around all over the place. Imagine just an extreme case. Imagine the entire assets of the banks were in Microsoft shares, which would be a terrible idea because you should never put all your eggs in one basket. Imagine they did. Then it's gone from 300 to, again, where's January 6th? There's January 6th. To 225. I mean, imagine the balance sheet collapsing that much. It'd be a disaster, right? Shares are very risky. Which is precisely why people generally don't buy a share. You generally buy a little bit of lots of different shares, and then that doesn't get rid of all the risk that you face, but chances are when one's going up, another's going down. Then that will cancel out, unless the whole market is going up or the whole market is going down. And then you're exposed to it. So that's the rationale for why it used to be forbidden for banks to hold shares. Now it's not. Not anymore, anyway. So, let's see, how are we doing for time? Any questions, comments about any of this? We have about 10 minutes left, and so you know what that means. We have enough time for a little exit quiz. All right. Let's go. First question, true or false? Loans are an asset of the bank. These are all midterm relevant questions. Of course, you need to know what's on the balance sheet, where it is. And of course, the answer is true. Next. True or false? Borrowings are an asset of the bank. Three, two, one. The answer is false, because they owe them to someone else. Next, if I make a deposit in a bank, what happens? Do the liabilities suddenly exceed the assets? The assets exceed the liabilities? The liabilities and assets equal? Or are the liabilities unchanged? The answer is the liabilities always equal the assets. Almost done. What is the bank capital of this bank? So here's the balance sheet. What must be the bank capital? Yes, you will be expected to do things like this on your midterm. It's 10. Next, last but not least, if someone withdraws deposits of 10 from this bank, what happens? The reserves decline by 10. Does the bank capital decline by 10? The reserves increase by 10. Does the bank capital increase by 10? Let's see. I think I put too long a timer on this one. The answer is, of course, the reserves decline by 10. All right. Let's see who won. If you won, please come up. I have a little something for you. Everyone else, thank you. Hope this was useful. And look forward to seeing you on Wednesday. The winner is... Zan. All right. If you're Zan, please come up. Everyone else, look forward to seeing you soon.